We talked about strategy first, and you guys are doing some presentations on that. The middle section is a lot of techniques. How do you get cost data right? And that's what we're in right now. How do you get the data right so that you can do some work with it? And then at the end, we'll talk about how it's used. Why is it important to get that data right? How do we use that to ensure that our strategies are being followed? How do you do that to ensure that your employees are doing the right thing? And how do you compensate your employees for doing the right thing? So that's kind of the flow of the class in general. 2 weeks ago, we focused on different kinds of costing systems. Today, we're going to focus on budgeting. Chapter 6 is about master budgeting, which many of you have probably experienced in some way or another. And then Chapter 7 and 8 involves something called flexible budgeting, which you may or may not have experienced. And as we talk about flexible budgeting, we'll talk about the last costing system, which we didn't talk about 2 weeks ago, which was standard costing. So today, Chapter 6 is master budgeting. How many of you have been part of a budget cycle in a company that you've worked for along the way? Is it fun? It is fun. Wow. It wasn't fun for me. If you're in the cost center, well, I've been on both sides. If you're in a cost center, the budgeting process is they ask you what money do you think you need to get the job done. You tell them and they say, no, cut it in half. If you're on the revenue side, they say, how much revenue are you going to be able to produce? You give them a number, they say, oh, double it. And that's the budgeting cycle. It's a give and take to find the appropriate budget for usually for the next year. And it's a process, if it's done right, that's collaborative. It's not a top-down process, but rather a process where each, we'll call responsibility center, has the chance to express their belief on what their budget should be, and then it's a give and take process to figure out what an appropriate budget should be. So we'll talk about why there's budgeting. We'll talk about the process itself, how do you prepare it, and how do you work within the world of uncertainty. Obviously, a budget that's produced before the year even starts. If it's a calendar year budget starting January 1st, the process usually starts in October. So October 2013 has to figure out how much goods you're going to sell and how much resource you're going to need in December 2014. That's kind of unrealistic. So there's uncertainty in the future that has to be included in the process. And then a few other topics at the end to wrap it up. So the purpose of a budgeting system. First of all, what is a budget? It's a detailed plan expressed in numbers that specifies how resources will be acquired and used during a period. So a budget is both, we'll think about it from a manufacturing perspective, a budget is both, we need to buy 100 pounds of this raw material, and we expect that 100 pounds of that raw material will cost a certain amount of money. So it's both in terms of quantities and dollars. Budgeting, the verb, is the process of preparing a budget. And why do you do it? You do it because you need to plan. If you don't have, it is your basic tool for planning the next year. If you're a cost center, if you're an IT department, the budgeting process tells you, here are the projects you need to work on next year. And here are the resources you will have, dollars and people, to do those projects. If you're a sales department, here's how much we expect you to sell so that we can hit our numbers and get to our bottom line. A budget is a communications document. Everybody in the organization sees the budget, they know the plan. It should align people towards goals and therefore allocate their resources appropriately towards those goals. Now, obviously, a company has to be flexible and be willing to move away from the budget based upon external factors that either say we can't meet those numbers or, hey, the world has changed, we have to shift our resources to be more effective. But it is a plan. Just because a plan is not followed to the T doesn't mean you shouldn't plan. It becomes a control tool because by using the master budget in conjunction with the flexible budgets, you will be able to figure out where and why you're either reaching your numbers or not reaching your numbers. Why are things not working the way you want them to work? And ultimately, and this is a dangerous one, you can use a budget to evaluate your employees and give promotions and bonuses and raises, etc. The challenge with performance evaluation is that the budget is a plan that's done well in advance, and things change. The economy could change, and to evaluate employees based upon a shifting environment in a vacuum is not appropriate. That's why things like balanced scorecards are important, to show not just how you did versus the numbers, but also how you did in other aspects of your job. Like everything, a budget starts from the strategy. And we know a strategy is a long-range planning effort, 5 to 10 years out. And you have a master budget, which is what we're going to focus on today, but you also have capital budgets. Capital budgets identify where do you need to make significant investment for the future. Do we need to build a new factory? Do we need to hire a significant number of new people over the long haul? So the capital budget is a tool for making long-term, large investments. Strategic budget expenditures are those expenditures that lead to long-term value and competitive advantage. I think we saw this slide the very first day or something similar to it. I won't go into it in too much detail, but right down here, you have your strategic goals, you have long-term plans that result in capital budgets, and then you have your short-term objectives, which is for the next year. That results in a master budget, which you then need to control, and you control that through the flexible budgets. The master budget is really an accumulation of a lot of individual budgets. So each department has their own budgets, and that's added up, and then you have the master budget for the company. The sales budget drives it all. How much do we expect to sell of all of our various products? That is the driver of all of your other budgets. Because until you know how much you sold, you don't know how much you need to produce. Or how much you plan to sell, you don't know how much you need to produce. And therefore, if you don't know how much you need to produce, you don't know how much materials you need to buy. So it's all driven from sales, or expectations for sales. I think this is a little bit confusing. Just wanted to make mention that there is something called a continuous, also called a rolling budget, which is a master budget that's constantly being updated. So you create a budget in January for the next year, or it's created in December for January in the next year. At the end of January, you create the next budget that goes through the following January. So you continually add an extra month on, and it keeps rolling forward. So you don't have an annual budget. You have a rolling budget that just is 12 months into the future at all times. Some companies work in this way. I've never worked for a company that does this, but I do know that some do. Most companies have a budget committee that reports in some way to the CEO, and their job is to make sure that the budgeting process is done appropriately. Generally speaking, budgeting starts at the responsibility center. So a department, they get to roll up the budgets. So every department in the company produces their budget. It gets rolled up into the company's budget. It's way out of line with how the company would expect to use its resources, and that's when the give and take begins, coming off of that. That's why it is a 2 to 3 month process. It is not a quick process. The end product from budgeting are pro forma financial statements. Everybody know the term pro forma? It's an estimate. It's a future look at your financial statements. So you'll actually produce an income statement, a balance sheet, a statement of cash flows from your budgets, and saying this is how, if everything goes exactly to plan, we expect to look at the end of the fiscal year. Again, you have two types of budgets, an operating budget and a financial budget. The operating budget identifies the resources needed, labor hours, materials, things of that nature. The financial budget identifies sources and uses of cash, because ultimately cash is king in any company. If you don't have the cash, you need to find the cash in some way. So if your budgets come in, you believe you can do all the work, but you don't have the cash, you'll have to either find a line of credit or some other source for that cash. In a nutshell, this is the master budget from here to here. Starts with the sales budget. You then have your production budgets that will lead to direct materials, labor, and overhead budgets. Selling and administrative budget. Your corporate overhead budget. You then can budget your cost of goods sold and cost of goods manufactured. And out of it comes the income statement, the balance sheet, and the statement of cash flows. So it all starts here, sales. The first step is to forecast volume, sales volume, and expected price for the products that you sell. We'll have this running example now through the rest of this section. Kerry Industries. They've produced this sales budget for 2010. They expect to sell 20,000 units in April, May, and June. It's a quarterly budget in this case, easier to work with. And they expect their price to be $30 for each unit they sell. Only one product for Kerry Industries to make it simple. And so here's what they expect in terms of total dollars their sales to be. And then, of course, their quarterly sales here. This is the sum. So let's remember the numbers here, 20,000, 25,000, and 35,000. They're going to run through, and then $30 a unit. Totally different example. I would like you to now calculate an expected budget. Very easy, just keep you guys awake. Craft bakeries, not Kerry now, have quarterly sales of 11,000, 16,000, 15,000, and 20. They expect through some very aggressive marketing that they will be able to increase their sales by 25% next year, 2011. But they don't expect their price to rise. So what would we expect their sales in dollars and units to be in 2011 by quarter? We'll just go over the first quarter since it's kind of basic. What's the sales in units for the first quarter? 13,750. You just take the 11,000 and multiply it by 1.25. And what's the sales expected to be in dollars? Anybody do that math? 55,000. Okay? Pretty straightforward. In many cases, what we'll see, and I think we'll see it for our real example, this was just a sidelight, you actually go period to period in increase. So you don't go year over year. But let's just say in January you expected 10,000 units to be sold. You expect in February, you expect a 5% increase by month or something, or 1% increase by month. So then February would be built off of January, and March would be built off of February, and that keeps increasing. You might see that model as well. Okay. So that's the sales budget. Pretty straightforward. Somehow, some way, you're going to plan next year in terms of volumes of sales and dollars of sales. You then will determine your production levels per period for next year. So the total amount you need to produce is equal to, in a given period, the amount you expect to sell in that period, plus whatever your expected ending inventory will be. So you're going to want to have some inventory in stock, minus your beginning inventory, whatever you had in stock to start the period. This is what you want. This is what you just figured out in your sales budget. So you're budgeting for the first quarter 13,750 units. That's your expected sales, your budgeted sales. Plus you want to have inventory. Usually this ending inventory is in some way related to what you expect to sell in the next period, let's say the next month. So if you expect to sell 20,000 units the next month, you might say we always want to have 10% inventory on hand on day one. So you'd have, if you expected 20,000 units the next month, then you'd have 2,000 units desired on the first day of the month. And your beginning inventory is what came from the previous month. Okay, we'll see this with real numbers. Okay, so for our Kerry Industries example, for how much we want to produce in April, a new piece of information, this is a given. They had 5,000 units of inventory at the beginning of the month from the previous month. At the end of the month, they want to have 30% of their sales for May available at the end of the month. So we had expected May to have 25,000 units of sales. So we would want to have 30% of the 25,000 units available at the end of April. And then the sales budget for April for Kerry Industries was 20,000 units. So this says they need to produce 22,500 units. The 20,000 units they expect to sell in April. The 7,500 units they want to have on hand at the end of the month, based upon 30% of the 25,000, which is 7,500, minus the 5,000 units they had on hand at the beginning of the month. So, in order to produce to the levels they expect to sell for that month, they will need to produce 22,500 units. Why don't you go ahead now, using the information we have, and determine what they need to produce in May. Okay? What's the beginning number of units in May? What's that? No. It's the ending units from April. Becomes the beginning units in May. What's that? These are the ending units in April. Give it a go. Try to do the work. What's that? That's on slide number 1, I think it's 13. Slide number 13. Who thinks they might have it? Don't give the answer. How much do they think they're going to sell in May? 25,000. What's their beginning inventory? 7,500, the ending inventory from April. So the only other number we need now is what's the ending inventory in April? The same rule, 30%. So what will we need 30% of? 30% of June's expected sales, which was 35,000, which I think if I did my math right, is 10,500. So how much you need to produce in May? I think that's 28,000, right? Okay, so from I think it's slide 13, it said that June sales will be 35,000 units, and we know we want 30% as beginning inventory in June, or ending inventory in May. So 30% of 35,000 is 10,500. Right, so your ending inventory in May requires a certain amount of level to start June. So your ending inventory in May will be 30% of your June sales. And so on and so on. So you now can do a production budget based upon your sales budget. Here's the 28,000 we just calculated, and then rolling forward. Obviously, for June, this desired ending inventory would have known July. We would have needed to know July sales to do that, which we don't have. So once you have a production budget, you know how much you're going to produce. You can then look at your materials, direct labor, and budget those. And you budget them on two different planes. How much you need to purchase and how much you expect to use. Just as you may want to purchase, or you may want to produce more so that you're ready for the next period with finished goods, you may want to purchase extra materials so that you're ready for the next period with your raw materials. So materials purchases does not exactly match materials usage, because you want to potentially have raw material inventories that differ from finished good inventories. Your direct materials purchases will be reflected both in number of units you need to purchase and the dollar amount of those units, the expected dollar amount. You need to understand the purchases as part of the usage budget. And the purchases budget is a function of the materials required. Of course, you're going to need to purchase enough for everything you want to produce that period. But it will also be a function of what you expect and hope for in terms of an ending inventory for your materials. Whatever materials you already had in stock. So it's very similar to the production cycle, just done separately because it has separate criteria. And of course the purchase price. So here could be a purchases budget for Kerry. They require 3 pounds of materials for every item produced. So in May we said they're going to produce 28,000 units of production. They require 3 pounds per unit, so that's 84. In April it was 22.5, I believe. That's times 3 to get 67.5. Plus there's some level of desired ending inventory. Not exactly equal to 3 times the production inventory. In fact, it's unrelated. It's how much inventory you think you want to have in hand of your direct materials. And then you would subtract out the beginning inventory. And that tells you how much you need to purchase in that period, multiplied by your expected price per pound for the materials, and you see there's some inflation effect here. Okay, so the process for direct materials is very similar to the process for the finished goods, but the numbers don't necessarily need to match up. The usage budget is how much direct materials you actually will be using that period. It starts with the calculation of, you know you're going to produce 22,500 units in April times 3 pounds per unit, so you need 67,500. And then you work your way down. And it gives you a cost for the amount that you're going to use. And this relates right to what we did in Chapter 17, how you calculate these costs. Not going to go into it here. So that's direct materials. Direct labor. Many of you will end up working for a service company. This is the one that counts. You know, if you work for an accounting firm, every partner is considered a responsibility center. You know, think about it, consulting. And then they report up to a group. Maybe there's a partner who reports up to the financial services group, which does all of the various financial services clients. And that gets rolled up, and each partner says, well, we think we're going to be able to sell this amount of work for these various clients we have. You have to figure out how many people you could hire, or how many people you need to hire, or do you need to shift your resources in some way. And so hiring of direct labor is an important part, both skilled labor and unskilled labor. So direct labor budget is prepared for every class of labor in the organization. It's derived in a manufacturing setting. It's derived from the production budget. You need to know how much you need to produce, so therefore you know how much labor you need to produce that. In a services organization, it's derived directly from the sales budget. And We'll talk more about standards, but you would use standard labor hours and standard wage rates to determine these budgets. So Kerry Industries knows they need a half an hour of semi-skilled labor and 2/10 of an hour of skilled labor to produce a product at $8 and $12 per hour, and then the math becomes pretty straightforward. You know how many units of production you have? You need a half an hour per unit. That's the total number of hours of semi-skilled labor at $8 an hour. That would be the total cost of your semi-skilled labor, and the same thing would be done for your skilled labor. Again, driven by the production and sales budgets. Factory overhead, not going to get into it in too much detail here, but you need to do the same kinds of things for factory overhead. That could be done at an activity-based level. You can do activity-based budgeting, ABB, which you would use in an activity-based costing environment, where you look at your expected number of setups, your expected amount of machine maintenance, and each of your activities, driven from an appropriate cost driver. In this more simple example, this is driven just simply by direct labor hours. And so this is more volume-based. So the various variable and fixed overhead categories are budgeted going forward. As you'd expect, fixed doesn't change or shouldn't change because it's fixed. And the variable is based upon the amount of expected direct labor hour usage, which in itself is driven by the amount of production, level of production, which itself is driven by the level of sales. You can now start to put together an income statement by period. Pro forma, meaning looking forward. You have your direct materials and your direct labor for April, your factory overhead, both variable and fixed. You have your cost of goods manufactured minus your beginning inventory, or plus your beginning inventory, excuse me, and then minus your ending inventory, and this will be your cost of goods sold. So this is just taking the numbers you've created in your budgets and starting to produce a cost of goods sold, which would then lead you to, well, a quickie on selling and administrative expenses. They need to be budgeted too. We won't get into it here, but you need to decide how much is appropriate for selling and administrative. You need to be careful as a company. If your other budgets aren't working out, sometimes you use this as a fudge account, but it's important in its own right, and you need to make sure that you budget your selling and administrative expenses appropriately. You certainly wouldn't want to cut down on your customer service because your other budgets aren't right. The next few slides will just really show you some of the things you can build from your detailed budgets. You can build a sense of your cash flows, your cash activity. You know how much you're going to sell. It says here that 70% of your sales are cash and bank credit cards. For a given company, a bank credit card is cash, right? The company is not taking on the risk of default. The credit card company takes on that risk. So cash and bank credit cards are 70% of your sales here, and credit sales, meaning you're providing credit to your customers directly, are 30%. And you're taking on the risk that they never pay you in that case. So This matches up with what we expect our gross sales were going to be. For April, 600,000. That's the number to look at. Now we'll separate out cash and bank credit. Cash is 60% of your cash and bank credit, which is 70% of your total sales. So now you have 42%, 60 times 70%, 42%. You're going to get all of that because the day you sold it is the day you got the money. Your bank credit sales, you're only going to get 97% in this example because the bank is taking its 3% to manage its own risk and its own costs. So you get 97% of 40% of your cash sales. And then your account receivables. The older an account receivable is, the less likely it is that you'll ever see that money. And so what you have here is aged account receivables. And so you would expect, at the bottom line here, you sold $600,000 worth of goods in April. You would expect, based upon your experiences, to get approximately $540,000 in cash. Now you could do a statement of cash flows. And you've seen these already, right? Along the way. And so they're divided cash flows from operations, investing, and financing. And it'll look something like this. With that number being your operating cash inflows. So you've done a pro forma statement of cash flows, and now you can do pro forma income statements and balance sheets. Pro forma income statement. Pro forma balance sheet. Again, just taking numbers that you've already created and adding them to or subtracting them from your starting position on the balance sheet. This is just a summary of the process. Now let's talk about a couple of things here. Sensitivity analysis. We're looking into the future. The future has a lot of unknowns. What if there's inflation? What if the cost of oil, the price of oil goes up? What if you have a new competitor, so your sales go down by 20%? So you would do a sensitivity analysis to understand your impact. In particular, you want to make sure that in your worst case scenarios, you'll be able to maintain yourself as a going concern. So you would do sensitivity analysis to understand what would happen in a down situation and how you would stay afloat. As I said, in terms of integrated budgeting software, it starts at the departmental level and works its way up. A larger, well-run company will have software that allows the individual departments to enter their data. It rolls up, and it's an integrated process to get to the correct final budget. As I said, in a service company, which many of you will be going towards, it's about labor, it's about skills for that labor. Zero-based budgeting, ZBB, zero-based budgeting. This often happens in a down market. The economy is bad. Companies trying to figure out how to cut costs. They don't want each department to say, well, it cost us $1 million to run our apartment last year. We'll cut 5%. It'll cost us $950,000. They say, start at zero and validate why every dollar you spend makes sense. So instead of taking your previous year's budget and either going up or down from that budget, In a zero-based budgeting environment, you need to go down to zero and rebuild your department from the floor and explain every dollar spent from zero. It's time-consuming. It creates bad will. It's a lot of negatives to it, but sometimes companies, when their backs are to the wall, will use zero-based budgeting as a way to reduce costs to a bare bones level. Yes, sir. It's not done that often. It's done when you need to, really. It might be done in if you're in a department that needs to be re-engineered, and the company at the higher level says, we really need to re-engineer that piece of the business. The first step is to ask the managers of that business to start at zero and figure out how you can do your business better. If you just go off of the previous year's budget, you're not going to have much incentive to do major re-engineering. This enforces that. Yeah, it's a painful process, so it's not something you want to do every year.
Is that also the bottoms up method of budgeting? Say, for example, if you don't have a set budget in the beginning, you're building from the ground up?
Yes, that would be. So if you're starting a company, yeah, you would would start at zero, and you have to build that budget from the ground up at that point, and you do zero-based budgeting. So either it's a new company or it's a company that wants to really rethink the way it's doing part of its business or its entire business. We'll do this. Activity-based budgeting, I mentioned, is the process of matching the budgets, particularly for your overhead costs, to the various activities that you would have in an activity-based accounting environment. I talked about responsibility centers. We're going to talk about them in greater detail in a few weeks. Hopefully these are terms you've heard of. A responsibility center is a subunit organization whose manager has accountability in some way for that unit. And that's the level where you would expect budgeting to occur. There are 4 types of activity centers, or responsibility centers, excuse me. There are cost centers, revenue centers, profit centers, and investment centers. A cost center is the part of the company that only has costs associated with it, doesn't bring in any revenue. It would be an IT department, an HR department, some kind of a service department would probably be a cost center, although you might see in some companies IT departments treated as profit centers. It's not impossible. Revenue centers are generally the sales departments who really don't care about costs. They care about bringing in revenue and only revenue. They usually come together in the organization at some level as a profit center, where you care about costs and revenues and therefore profit. It's quite often a more senior level of the organization that cares about both costs and revenues. And then the investment center is even more senior in the organization. They care about cost, revenues, profits, and how do we make investments for the future. And in a few weeks, we'll talk about these more. I don't want to get into them today, except to say that at this level is the level that you need to do your budgeting. This just shows that you have cost centers and revenue centers that usually roll up to a profit center, and then profit centers roll up into an investment center. It's more senior. Some behavioral issues in budgeting. Budgeting is a gaming system. Remember, one of the purposes of budgeting is you want to use it as a way of evaluating your management, your responsibility center management. Well, if the manager does not feel a degree of control over the budget process, that manager is not going to own that process, and if they don't own it, they're probably not going to care as much as they should as to whether or not they meet it, which is why you tend to want to do a bottom-up budget. You want the manager to feel ownership, and then it becomes a better control tool for that manager. Goal congruence is the idea that you want to make sure that your managers, their personal goals, match your corporate goals. And so a well-designed budget will lead you to goal congruence. A poorly designed budget will not. Which is why, as we've said over and over, participative budgeting is better than top-down budgeting. The difficulty level of the budget. If you make a very difficult budget to meet, then discourages the managers. I can't make it, I don't care. My bonus is based upon whether I make budget. I have no chance of making budget. Oh well, not getting a bonus this year. You dissent them from working the very best they can with a very difficult budget. Of course, if you have a very easy budget that's easy to meet, you disincent employees from putting in that extra effort. Oh, we're going to make our budget, we're good. No problems, we'll make it. So you need a budget somewhere between outrageously difficult and too easy. You need a reasonable budget. A Kaizen budget. Who's heard of that? Anybody? Comes from Japan. The idea is it's a budget that continually gets harder and harder. Starts off easy at the beginning of the period, and you expect there to be learning. You expect there to be continuous improvement in the organization, and so you keep tightening the budget a little bit over time so that you create a more efficient environment over the course of time.
Is that over one fiscal year, or is that over?
Well, Kaizen budget is usually over the course of time. Yeah, a company is a believer in a Kaizen budget and they keep it forever, and so how frequently you demand improvement could be monthly or quarterly. You know, each company has their choice, but this is a budgeting approach that a company takes for the long haul. Okay, budgetary slack. Anyone who's ever produced a budget has attempted to produce some slack. You know, you just throw some stuff in there. Just padding the budget, trying to give yourself and your employees a little room to breathe. That's what the bottom-up approach will do. And that's why you have also the top pushing and trying to find that happy medium in between. And then there's this thing called spending the budget. Spending the budget. This is rampant. This happens for real in every company I've ever been in. The idea is the budget ends in December. You know, January's the new year. You're in December, and you haven't quite spent all the money you had. And since most companies don't budget zero-based budgets, they budget off the previous year's budget. You want to spend up to your budget level. Otherwise, senior management's going to say, look at that. We budgeted them $1 million. They only spent $900,000. Let's only give them $850,000 next year, right? So you're going to spend everything you can so you get back up to that $1 million, so they give you $950 for the next year. It's called spending the budget. It's real. And you know, it's not just real at the junior level. You'll have senior people telling junior people, spend. You know, pre-buy, pre-purchase things that you'll need next year so that you get up to your budget level. It's not just the concept of a junior responsibility level manager doing that. It permeates organizations. Okay, so the beauty of budgets are they provide feedback. But a master budget alone doesn't provide a whole bunch of feedback except to say, here's what we expected and here's what we did. It doesn't answer the question why. And that's where flexible budgeting will come in later chapters. And the use of variance analysis will provide a basis for ensuring that we're doing the right things. Okay? That's master budgeting. Any questions on that? Okay. Okay. So we discussed master budgets happened statically once a year unless they're a rolling budget. A master budget is forward-looking. It doesn't give you any information in and of itself as to how well you are doing. It just gives you plans on what you should be doing. So we need a set of tools to tell us in reasonably quick, real time how well we're doing versus our plans. And not only how well are we doing, but to the extent we can, why are we doing what we're doing? Because if you can figure out why, then you can take corrective actions if there are problems. So we'll talk about flexible budgets. Chapter 7 talks about flexible budgets in relation to direct costs. Chapter 8 talks about flexible budgets in relation to indirect costs. It's my goal to get through them both in the next hour and 10 minutes. And probably, as we did 2 weeks ago, give you all one class problem to work as a team to hand in next week, rather than try to squeeze that in to the next hour. So, in Chapter 7, we're going to talk about going from a master budget to a variance analysis. And to do that, you go through flexible budgets. To do that, we really need to define standard costing systems. What's a standard cost? Something we did not do 2 weeks ago when we talked about the various costing systems. Some definitions. Controls are a set of procedures, tools, and systems that allow you to monitor activities, and if done correctly, will point you towards achieving your strategic goals. Really, when you're doing variance analysis, you're doing management by exception, meaning you're looking for exceptions, either positive or negative. Usually you look for the negative, and then you manage those exceptions to solve the problems to move forward. Another type of management that is done, and we'll talk about later in the semester, is management by objectives. You assign managers objectives. They could be financial objectives, could be in terms of training their people, whatever those objectives are, and then you reward them based upon their performance versus objectives. Variance analysis is management by exception, looking for those areas that might be a problem and doing something about it. And you use management, accounting, and control systems to get the information so that you can do that management by exception. So as you're looking at your performance, you really want to look at 5 parameters. Are you selling as much as you expected? Are you selling for the price you expected? Are your variable costs per unit as expected? Are your total fixed costs as expected? And finally, and we're not going to do this in this chapter, we're going to do this later on, you look at your sales mix. Are you selling the products that are giving you the best results? They talk about sales mix in the appendix of Chapter 7. We'll talk about it in more detail in a later section. So you don't need to focus on the appendix to Chapter 7 when you read it. So those are the 5 categories that you would want to look at. The master budget, as we talked about, budgets these items. It budgets is the sales volume. It budgets the price that you expect to get per item and your costs. So you have budgets. You have a basis for getting started. And then you do your variance analysis based upon your standard costs. And if you remember this slide from 2 weeks ago, we were able to cover everything in green. We left out standard costs. Let's talk about it briefly right now. A standard cost. It's the cost you expect to incur under efficient operating conditions. You expect to use 3 pounds of aluminum to build a product. You expect it to take a half an hour of unskilled labor to complete that product, whatever it is. So it's the cost that should be incurred under efficient conditions. It doesn't matter whether you're job costing or process costing. It can be used in either environment. But what it really does well for you is it gives you a control. You expect something to happen. If things don't happen as expected, that creates a variance that you then get to understand. Why did you vary from that standard? And the variance might be because your standard was bad. But it might be because something was being done incorrectly in the process. Standard costing can be used in your accounting systems, but doesn't have to be used in your accounting systems. So you could record your costs as you go along based upon the standards, and then as you, at the end of the period, find out what your variances are, you adjust those costs and revenues to handle those variances. So you can actually journalize based upon your standards and then adjust based upon your variances, but you don't have to. It does not have to be in your accounting systems. That's an option for each company. The basis for standard costing is something called a standard cost sheet, which essentially defines the standard costs, both dollars and time that you would have, or quantity. So an example of a standard cost sheet for the Schmidt Machinery Company says you expect to need 4 pounds of aluminum to develop XV1. The cost of aluminum is expected to be $25 per pound, so you expect it to cost you $100 in aluminum. That's your expectation. And down the line, this is a typo here. That should be 120, not 180. Of course, 400 plus 180 does not equal 520. So that's just a typo. Okay, so this is just standards, not budgets or anything else. It's what you expect it to take to produce 1 unit of XV1. Now, you have options on what you're going to use as the basis for your standard. And we talked about these already to some degree. You could use an ideal standard, meaning in the best case scenario, with no wastage, everything's working efficiently, what should we need? Obviously, that's going to make it very difficult to meet the standard, because if you're using that ideal standard as the basis for your budgeting, you can't do any better than that, so you're always going to find negative variances off of that, or usually going to find negative variances off of that. You could have a Kaizen or a continuing improvement standard. It'll take this much now, but over time we expect to be more efficient. Our labor costs should go down, and so you continually tighten your standards. Or you can create reasonably attainable standards. Obviously, this is the one that provides the best scenario for the workforce. Reasonably attainable within the confines of what you do. And there are 2 ways to define these standards, authoritative or participative. Which one do you think is better in the modern world? Authoritative. Authoritative. Okay. How many say authoritative? 1. Okay. Participative. Of course. Because again, if it's authoritative and the workers do not buy into it, what you have is something that will not be followed. As you establish your standards, the first thing you need to do is define the level of quality that's important. So, aluminum, you decide that for the product we're producing, it has to be 2 millimeters thick or 3 millimeters thick. That's the quality level that's required for this product. From that quality level, you can then define how much you'll need. And from the quantity and the quality, you can then figure out how much will it cost and when will you need to get it. Direct labor. Standards in direct labor are a little bit trickier. It's based on the type of work, the complexity, the skill level, whether there's going to be learning curve, the condition of equipment. There's a trade-off between machines and labor, right? You may choose purposefully to continue to have old machines, which will require more labor. Or you may say, we'll purchase brand new machinery and reduce our labor. You may trade that off for a variety of reasons. The most straightforward way to assign standards for labor is through industrial engineering, to do time study analyses. See how much time it takes to do a task correctly. So you bring in industrial engineers, management consultants, etc. You use the employees as well to do the work, to define the standard. Of course, labor contracts often define that standard for you. Contracts are very specific. In the auto industry, for instance, how much pressure you can put on employees to get the job done. So sometimes the labor contract itself defines what that standard should be. And then the personnel department, in conjunction with management, will figure out wage rates, and contracts as well will figure out wage rates and benefits. Okay, so now you have a master budget based upon some standards that you have. Now you want to figure out how you're doing as you go through the budgeted year. If you have a cost variance, how much of that cost variance is due to maybe lower sales than you expected, and how much is due to just bad cost control at the sales level that you did expect. And so what you do is you flex the budget to actual activity. So a flexible budget actually says you have a master budget, you have actual activity levels. Let's say you expected to sell 1,000 units or produce 1,000 units, and you only produce 750. Well, based upon holding everything else constant except the level of production, how much should it have cost? And then use that to compare to the master budget. And that's your first level analysis. Level 0, actually. So you just use actual activity versus budgeted everything else. And we'll see it in action. It's prepared after the period is over, let's say the month. And this just says you use the actual sales volume, but you use the budgeted price, the budgeted variable costs, and the budgeted fixed costs. And this is the beginning of your variance analysis. We will, in the next 2 chapters, talk about everything but the sales mix. So you have the 4 items that you're looking at, and you can start doing variance analysis on all of them, and you can keep digging deeper and deeper to understand causes and the reasons why. Let's stick with Schmidt, the company we started with for this chapter. This is their master budget. They expected to sell 1,000 units. They expected that each unit would sell for $800 per unit. So they expected $800,000 in this period. They expected the sum of the variable costs to be $450, giving them a contribution margin of $350,000 or $350 per unit. Their fixed costs, just one number, $150,000. They expected a profit of $200,000 at the 1,000 unit sale level. Oops. They only sold 780 units. And so here are their actual results for the period, for the month. They sold 780 units. They were able to bring in $639,600. Their actual variable costs were $350,950. So you see their contribution margin. Their actual fixed costs for the period were $160,650. Yes, sir. Yeah, at the end of the period, you accumulate your costs, your actual costs. So this is given. These are the actual costs that they had. We know that they sold 780 units. You had your budget, and you have your actuals now. And so they actually had $128,000 of income. They were hoping for $200,000 of income. And so it was not a good month. But why? Anyone want to just venture guesses on what's not working based upon the information we have?
Sales were coming in inspection came lower, and you also had higher fixed costs.
Good. So their sales were lower, and the fixed costs were above the 150. We thought it was going to be 150,000. Good. Let's see what else we can kind of figure out from this, if anything. So let's look at the total variance. Just the budget versus the actual at the total level. Use all the actuals here, use all the budgets here. Nothing else. We sold 220 units less, so that's unfavorable. U is for unfavorable. Unfavorable is bad. Favorable is good. These are different than over or under applied, which we talked about the first week. So this is a different U. Total revenues were unfavorable. Look at that. Variable costs were favorable. But we expect it because we sold less. The margin was unfavorable. Fixed costs were unfavorable, resulting in an unfavorable overall operating income. So some questions you might ask. Why is the income less than expected? Why have expenses gone from 75% to 80% of sales? Why were fixed costs $10,000 more than expected? And then what contributed across these categories to the disappointing results? So a variance analysis is kind of like peeling an onion. You've heard that term, right? Peeling an onion, you just keep getting deeper and deeper into it. You start off with the static budget variance. Then you go down further and further. So the static budget variance is what we saw there. You look for favorable variances and unfavorable variances. Generally speaking, as you're peeling that onion, this is the general model of what we're doing. Remember, the static budget, we're just comparing all your actuals against all your standards or your budgets. But what you really want to do is separate out how much of it was due to price and how much of it is due to quantity changes. So in the middle, between them, you use your actual quantity and your standard price at whatever level you're doing it. And that's the flexible budget right in there. That's the flexing. This middle piece is the flexing. So you can then say the difference from here to here is due to quantity variance, and the difference between your actuals and your standard price is your price variance. Okay? This is the difference between your standard quantity and your actual quantity, gives you your quantity variance, and the difference between your actual price and your standard price gives you your price variance. So that's the general model of what you do as you peel the onion. This is kind of the onion peeling picture. You start off with that static budget variance. You get a sales volume and a flexible budget variance, and then you take this flexible budget variance and you really dig down all the way to find out which of your materials are causing variances, is your direct labor causing variances, and if so, is it a rate variance problem or an efficiency problem? That's the peeling of the onion. Let's start peeling. So the level 0 was just how much were we off? We were off by what, 72,000? I forget the number now. Level 1 answers the question, where were we off? And then the later levels will answer the question, why? So the first thing we need to do is calculate a flex budget. You start with the master budget. You then look at your actual output, and then you extend all of your line items from the master budget except you use the actual output. If you feel, this is where you get to use some management discretion, if you believe that you were reasonably close in terms of your actual output versus your budgeted output, then you just keep the fixed costs in your flexible budget from your master budget. That's a discretionary decision you get to make. It'll figure itself out later when you do your fixed cost analysis anyway. Okay, so the flexible budget for Schmidt would be based upon the actual sales of 780 and the budgeted price, variable costs, and therefore contribution margin. You can see here we chose to keep the fixed costs from the budget at the 150,000 level. Could have chosen the actual if we thought it was appropriate. So the flex budget says we should have had operating income of $123,000 at this sales level, all other things being equal. That's what the flexible budget says. So we can now start to do some more variance analysis. This is our actual column, which we saw earlier. This is our master budget, which we saw earlier. And this is our flexible budget, which we just created. Okay, which was created on the slide before. The difference between the flexible budget and the actual results is called a flexible budget variance. And the difference between the flexible budget and the master budget is your sales volume variance. So what is this telling us? It's telling us that we would have expected to have earned $77,000 less based upon the sales volume that we had. This tells us we only earned $72,000 less, so our flexible budget variance is actually a positive $5,000. Something appears to be good. So the vast majority, or more than the actual amount, is due to the fact we just sold less than we expected, and our fixed costs are high, and that's what caused it. But there's more analysis here. Sometimes positive variances tell you a negative story. And we don't have facts here, but I could make, as we dig deeper, you might be able to see where that might be a problem, that positive variance. So this 5,000 favorable is the flexible budget variance. And it's due to the fact that the selling price differed from plan, the variable cost differed from plan, and to the extent that you used a different fixed cost, it differed from plan. The other side is the operating income variance of the sales volume variance, of 77,000, unfavorable. Since everything else was held constant, that's just telling you you sold less than you should have. Okay, so here's a little work for you all to do. Different problem. Just do a quickie little some math. The Baldwin Company predicted sales of 160, variable cost of 48, and fixed cost of 48,000, and fixed cost of 52,000. You see the actuals. What's the total, not the flex budgets, what's the total variance for the Baldwin Company in that year? Can work with your teams to work on this. The actuals.
180.
So what was 64,000? 54,000. So your contribution margin is 126. And then fixed costs were what? That's 76. So that's your actual. And then your master budget. What, 160? $48. Contribution margin of 112. So that's 100. That's just 60,000. So what's your variance? Your overall static variance? 16,000. Favorable. Your actual is better than your budgets. That's favorable. You did better than expected. Okay? Pretty straightforward. Yeah, it was just a pleasant little diversion. We've seen that we can calculate the flexible budget. That's what we did before this little diversion. Now let's see how we can break that flexible budget down and get more knowledge. We see that we would have expected to sell $624,000 worth of goods. However, we sold $639,600 worth of goods, giving us a $15,600 favorable variance here. What's this variance due to? Price. It's a price variance here, right? Because they have the same quantity sold. They just raise the price higher. So when I say a favorable variance might be a cause of a problem, this is an example, right? You actually have a favorable variance of $15,000 on price, but maybe your price is too high. Because you have that favorable variance in price, you only sold 780 units rather than the 1,000 units you should have sold. Maybe somebody in sales made a bad decision to raise the price. This is why you do a variance analysis to try to understand causes. So that's what we just said. The selling price variance was $15,600 favorable. Calculated two different ways. Well, here's a chance for you to do a selling price variance problem. Why don't you guys go ahead and do this? $52,250 unfavorable. Good. How'd you get it?
The actual quantity is
Okay. Times what? Why times 32? Okay. Yeah. Yep. So that'll be 9,500 times negative 5.5, and that's how you got to the unfavorable. Your actual is negative. It's under. Good. Hopefully everyone's getting that analysis down because it's important. Remember, we kept the master budget's fixed costs, $10,000 plus dollars unfavorable in fixed costs. You'd have to do an analysis to understand what caused those fixed cost problems. It's quite likely that you could not judge those fixed cost problems on the factory manager. There might be things that are completely outside of the control of the department. The variable costs were pretty much on budget. Not much to say about that. You paid approximately what you would expect to pay in variable costs for producing 780 units. So really, your budget challenges were due to three things: a positive pricing, negative fixed costs, negative sales volume. And the math's the same as the math is for as you go layer to layer, the math stays the same. It's just a different layer of analysis. If this were a flag, you would continue to decompose it. So if the variable costs did appear to be a problem, you would then want to understand, are those problems due to direct materials or are they due to direct labor? If they're due to direct materials, which materials caused the problem? So you'd keep peeling the onion, looking for variances that are material and important. Which is really what we're saying here. At every level, you're looking for price variances and usage variances. Usage variances. If you had a variable cost of direct materials that had a significant variance, was it due to the fact you needed more materials than expected? Or was the price of the materials not what you expected? And by how much? Same picture we had before. Nothing new here. Okay, let's go through an example. It's going to be about 3 or 4 slides on this example. Hansen Company makes a product called Jerf. Their standard costing system tells them they need 1.5 pounds of stuff to produce jerf. And that stuff costs $4 a pound. Last month, 1,700 pounds of materials were purchased and used to make 1,000 jerfs. And the total cost was $6,630. What was the actual price per pound? Actual price per pound paid for the material, the stuff. Raise your hand. B, C, D, C it is. The answer was C, $3.90. Same problem, same numbers. What was their material price variance for the month? Material price variance. What do we have? A, B, C, D. The answer is A. I'm sorry, B. B. Sorry about that. Got you excited for a second. The answer is B. It's $170 favorable. It cost him $3.90 a pound rather than $4. That's a favorable 10 cents a pound less at 1,700 pounds. So that's 170 pounds favorable. Okay, same problem. How many pounds of material should they have used to produce 1,000 jerfs? This is a quick one. A, not going to give you any more time. B, C, D. The answer is B. 1.5 pounds is the standard. They should have, for 1,000 pounds, or for 1,000 jerfs, they should use 1,500 pounds. That would be your standard quantity of materials. Same problem. What was their usage variance? This one's a little bit more tricky. A, B, B, no, C, D. Bless you. The answer is C, $800 unfavorable. That comes from the fact that their standard said, based upon the volume of output, they should have used 1,500 pounds of the material. They actually used 1,700. So that's 200 pounds unfavorable at $4 a pound. That's the $800 using the standard price. Okay. So what's some of the causes of direct material variances? Maybe you chose to buy better quality product at a higher cost. Not necessarily bad. Maybe you were able to negotiate price discounts. Or maybe you weren't able to negotiate price discounts because your sales were lower. Maybe the price changed. Maybe you had rush orders that caused you to get goods before, in a quicker fashion, so you had to pay extra. Those would all be reasons for price variances. Quantity variances, maybe you purchased lower quality good. Maybe you decided to try something different and see if a little bit lower quality raw materials would work for you. Well, you needed more of it to get it done. Maybe your employees weren't trained right. Maybe you have new people coming in and they're not doing the job the way they should, and there's more waste than usual. Maybe your machinery needs to be maintained better. So those could cause quantity variances. With direct labor variances, maybe you use a different class of labor. Maybe you've substituted in new labor for your old. Maybe your intention, the reason you might have a higher price, was to use a higher quality labor because you expected higher quality labor would result in lower materials costs. Maybe your standards are wrong. The efficiency rate, on the other side of it is the quantity variance or the efficiency of your employees. Their training might be substandard. If your raw materials are poor, it could result in inefficient work. If the equipment isn't very good, you might have a lot of downtime of your employees as you're waiting for the equipment to be maintained. And again, out-of-date standards. So there are a variety of reasons for direct labor variances. The key is find the variance and then work with it. So standard costing is very useful. It's used all the time, but it's not the whole story. Because if you're going to incent your people on their variances, you may create short-term thinking. Maybe you don't maintain your equipment as readily because you don't want those costs. So you might end up, maybe you purchase substandard raw materials or cheaper labor. You need to be careful to look at both favorable and unfavorable variances. You don't just look at unfavorable variances, because a favorable variance, like you had the favorable price variance, that may have caused another unfavorable variance somewhere. So you need to look at all of your material variances to understand their causes. And standard costing is a fairly expensive process. You have to bring the industrial engineers in. You have a lot of work to do. So some companies are just not going to invest in it. Okay, here's what we're going to do. I'm not going to do Chapter 8 today. I think it'll be overkill. So